Ariel, ¿nos oyes?
¿Escuchas a mí?
Perfectamente. A ver si funciona el ratón.
Ahorita no oigo.
Claro,
Ahorita sí.
Si pasa algo con el que de vez en cuando se desconecta solo. No sabemos qué está pasando.
Ah, ok.
Estoy pendiente. ¿Tienes mucho retardo por detrás?
¿No?
Está perfecto, entonces. Muy bien. Si ves que te molesta que tienes mucho audio por detrás, lo ponemos en mute, ¿vale?
Vale.
Pues vamos, si quieres, empezamos. Bueno, primero, muchas gracias por atender la llamada, sobre todo en tan poco tiempo. I'll take it in English. Sorry. I started in Spanish with you, and I'll take it in English. So everything is going to be in English, Ariel. Okay?
Do some of the people know speak Spanish?
Yeah, I start talking in Spanish. I don't know what is going on with you, so I start talking in Spanish with you. So it's very complicated. So first of all, thank you for being here. It's very early in the morning in San Francisco, I know.
I had my coffee here.
Is deactivating right? Okay, sometimes. I'll make it very short. It was about 5 years ago, 5.5 years ago, we met in some beach in Hawaii. Mm-hmm. Things have changed a lot since the beginning. I think we have had an amazing friendship. I need to be saying thank you for all the programs you've been mentoring in all the batches, and that is very nice of you. Also, I think you have been very successful in your investment. Some of them have been a home run, we can say. So they know your profile, they know your Crunchbase profile. I don't know if it's up to date, more or less, maybe.
Crunchbase, in general, for most people, is not super up to date. It's usually somewhere between a half or 2/3. So when you look at that, just be aware that they're not super up to date in general.
Anyhow, I think it reflects that you've been a very successful and investor in Silicon Valley. You've been doing, I don't know how many investments. They claim about 26. I think it's much more than that.
100.
Over 100 right now. Yeah. Okay, so definitely it has to be up to date. Yeah. And as we have discussed, I think the most important for the teams we have here is that you can give them a quick feedback about the things that they should be doing when talking to investors. I think that's the most important thing. So you got a slide deck about what you're doing, a small one. You will get another one also by the end of the investor week. We have opened up a full week for investors in order to allow them to come here and to talk to both startups. I think we will be doing a much more an event that is much unique for both startups and investors. Mm-hmm. So we'll start on Tuesday next week, but as it is almost impossible to have you book during the investor week, I think it will be great to have you here. So without any further ado, so if you want, you can introduce and everything. I'll be on mute, so if you don't hear anything, I'll do something, and we'll do something on the back.
Thank you, Rafa. Yeah, no, and congratulations on all the progress you've made since we first met. The office looks great from here. So one thing for everybody, feel free to interrupt me or ask me a question. So since the mute, just raise your hand and then I can pause, and usually that helps me. So by all means, don't be shy. Initially the guys had asked me, hey, can you do a 10-minute hear everyone's pitch? But what I have found in the past is that I do that and I'm just hearing the pitch and asking questions. And that's not necessarily valuable for the entrepreneurs, because for me, it's unlikely that I'm going to want to invest in one of your companies because I'm in Silicon Valley, you're in Spain, in Europe, and it's not, unless there's something that's specifically in an area that I'm interested in, it's not going to conduce to an investment. So what I said is, well, why don't we try to do something that's helpful for you guys? So what I'm going to try to do is do a quick, maybe 20-minute. I'll just go through some slides that I have when I give presentations similar to this. And then, which by the way, I wonder, should we try to do a little, I don't know. No, I'm not gonna do a screen share, it's not worth it. There's not a lot of graphical support anyway. I'll just use it as a guide. So I'll try to
one, and you can do it if you want, it's up to you, but Google Hangout will allow you to do it.
Yeah, let's keep it. It's not worth it. The presentation, let me just say something though. The presentation is in SlideShare. So if you go to SlideShare, one of my good investments, if you go there and look at my profile, you'll see the presentation. So you can feel free to go there and follow there or to see it afterwards. I used it recently. I made a few tweaks, but I used it recently for a similar group. So let me just dive right in. I assume you all know my background. The short of it is that I've been involved in terms of doing my own companies, being a board member, being an investor, early stage, medium stage, later stage. So I've sort of like seen all the pieces. Very important point I would make is my experience is almost exclusively Silicon Valley, and Silicon Valley, it's another world. And that's very important in several ways. One is when somebody from Silicon Valley is giving you feedback or talking to you, remember, you're not in Silicon Valley, you're in a different world. And Silicon Valley, it's not because you're in Spain or Europe. The definition of Silicon Valley is anywhere between roughly San Francisco and San Jose, and maybe anywhere else you can Uber to. What that means is that Sacramento is not Silicon Valley, Los Angeles is not Silicon Valley. So for us, Madrid, Malaga, LA, they're equally foreign. And it's an important point to make, which is you shouldn't feel like you're more foreign because you're in Europe than say somebody who's coming from somewhere else in the US. What makes Silicon Valley so unique, you probably know it. We have it all down. It's a formula. It's just such a dense community of people who are into the entrepreneurial stuff. And we do things here differently just because we can do this, get companies going without stopping to think too much about how do you do this, how do you do that. Everybody knows and moves forward. With that, let me jump into some tips for pitching. And I assume most, if not all of you, are going to be fundraising in the next 6 months or so. Can you raise your hand if you're going to be fundraising in the next 6 months or so? Most people, yeah, okay. So most important thing for fundraising is who you pitch to. The quality of the pitch and every detail about how you present that is secondary to who you're talking to. So the analogy I use is you go on a date and you're very nervous. You take her to a French restaurant or to an Italian restaurant, yellow flowers, red flowers. Well, guess what? If there's no chemistry, it's not gonna matter. You're done. And the flip side is if there is chemistry, it's not gonna matter. You're gonna be in good shape regardless of where you go to eat. And investors are very similar. So the biggest mistake I see entrepreneurs do, they don't pay enough attention to doing research and homework and tracking down who are the investors who are most likely to be receptive. And that's 80% of the effort. So go look for people who invest in your space, who invest in your region, and then try to find those who you're gonna connect with also at a personal level. Then a few other, in terms of the pitch itself, biggest issue I see is confusing a company pitch with a product pitch. Product is obviously very important, but you're not trying to sell your product or your service. You're pitching your company. So things like distribution, unit economics, obviously the team, most people do include the team, but those are things that are often barely mentioned. You know, it's like 70% the product, 20% the team, and then 10% everything else. And it shouldn't be like that. It should be like 20% the product, 20% the team, 20% marketing, 20% unit economics, and so on and so forth. Final thing about pitches is, particularly here in Silicon Valley, it's not about getting the investors to check boxes so that they go, this is okay, this is okay, this is okay, it's okay. Because most investors have many more interesting opportunities than they can invest in. Like, you know, to give you I see maybe for every investment that I do, let's say that I turn down most of people who tell me they want to meet with me. Most I say no. And then of the ones that I meet, it's a high bar. Let's say that I see 10 for everyone that I do. And those 10, there's probably 3 or 4 that I like. That if I could do an endless number of investments, I would do. So out of 3 or 4 that I like, I got to pick the one that's most exciting, that gets me, really touches me at an emotional level. So it's not about checking boxes. It's about getting the investor excited. I'll keep going, but feel free to interrupt me, ask a question, what have you. If the investor is not excited, he is unlikely to tell you this is not exciting enough. Or if he doesn't like you at a personal level, he's unlikely to say, yeah, I don't think you seem to be arrogant, or you seem to be stupid. Or they just find an excuse that is easy, non-confrontational, and that leaves the door open in case things go really well. So they'll say you're too early, or you know, I'm finishing my fund, come back to me in 2 months, or I want to see more of this or more of that. But the reality is there are 2 answers. Either they give you a check or it's no. And be careful to go chasing, oh, they say I need X, I need Y, let me go try to do that. They're just giving you an excuse. And don't spend too many cycles trying to address it. Now, if you can get a back channel information from somebody, if it's a warm intro and they'd say, I put you in touch with someone that I know here and he says it's too early, then you might ask me, hey, Ariel, can you try to get to the bottom of why did he say no? Because again, whatever he said is not true, in all likelihood, and then I might be able to get to the bottom of it. And again, investors like to keep their options open, because who knows? Maybe this looks terrible, and this happens to all of us as investors. A deal looks horrible, and next thing you know, 6 months later, something happens, and boom, they're taking off. So we want to be able to say, hey, I told you I was interested, but not quite ready. Now I'm ready. Well, so just be aware of that. Yes.
So is
No?
Alberto? Yeah.
Okay. So hi, Harry. Alberto here. So yeah, like what you describe is like probably 99% of the cases when talking to investors, especially at the early stage startups as we are. And as you said, they probably take like a defense position is like, okay, come back in a few months with more metrics or more numbers or whatever. So like as entrepreneur, like what would you answer? Would you trying to get the answer on the spot? So either you invest or is a no, or what?
No, I mean,
or just stay passive and accept that okay, there's an 80% chances that won't turn into an investment even in the future.
So I would just take it as a no. So, and if it's no, it's no. Again, let's suppose you ask, I'm going to go back to my dating. Let's suppose you ask a woman out on a date. If you're a woman, you ask a guy out on a date, and she says, oh, Saturday, sorry, I got to work. And then the next time you say, hey, Thursday, oh, Thursday, you know, I have yoga. And you're asking, and she's always giving you excuses. You know, if you say, tell me, why don't you want to go out with me? You don't do that, and she's not going to tell you. But maybe you go to her friend and say, hey, Sarah, you know, I'm trying to go out with Lucy. And just keeps making excuses. What's going on? So Sarah might talk to Lucy and say, you know, she's saying, unfortunately, you know, she noticed you have a bit of a bad breath, and just, that kills her. And so you're done with her. But she's not going to tell you you have bad breath. So trying to push the investor like that, it's a bad idea, with one exception. If you're in good shape and you're closing your round, and then there's somebody you really want, you can go and say, hey, look, Mr. Investor, this is happening, and you have 2 weeks or 1 week if you want in. And then what's really interesting is most investors, the same decision they're gonna make in 3 months, they can make in 1 week, particularly here in Silicon Valley. So, and when things are happening and other investors are participating, that makes them feel better. What you should do when somebody gives you those, oh, it's too early, I want to see this and that, assume it's a no, and then do 2 things. A, focus on trying to move your company forward. The best thing you can do for fundraising is move the business forward, make progress. And in most cases, you can do that even while you're fundraising or before you fundraise it. So try to do that. And try to think about who else is there another investor that might be a better fit? And then maybe you go identify a better potential investor. That's what. And then the third thing, as I said before, is if you think someone can get you back channel info, do that.
But actually, asking the investor itself, like about the referral to another investor. So okay, so maybe now it's not the right time for you, but would you be able to put me in touch with somebody that is more that? Like,
I mean, it doesn't hurt to ask, and in a small percentage of the times, I'll see something that I really like, but that I just doesn't make my cut, or it's just not a space I'm interested in when I can think of someone. But that rarely works, because in general, if I'm saying no, most investors, if I send something, they'll say, "Are you investing?" And I say no, and then they go, "Okay, then why are you sending this to me?" So now you have to also, it's not black and white. If the investor is being very friendly, if you think there's a real legit reason, plus worst case scenario is you get an investor who's not interested. But that doesn't work as much. I mean, the other thing to keep in mind is ideally you want to try to build relationships with, particularly with the better investors, where it's not just about you give me money, you're not giving me. So instead of saying, hey, give me another investor, what I would say is that, would you be open to maybe if I have a question, if I can have some feedback, if I keep you posted, would you be open to establishing a relationship with me? If they say yes, then maybe a few weeks later you say, by the way, we just grew our conversion, improve our conversion or grew our revenue. You sort of like try to build a relationship, and maybe after a little bit of that, you say, I know this is not for you, but can you think of somebody else? As opposed to right when they say no. All right, I'm gonna keep going here. Any of you thinking of fundraising in Silicon Valley?
hopefully.
No. Good.
Yeah. You're 3,
Good.
4.
Is there somebody thinking of raising in Silicon Valley?
Yeah.
So, oh, I see another one on the right. So it's very hard. And again, I don't know the specifics of your businesses, so just take this as a high-level generic point of view. But again, we have so many great projects here. Most good investors have way more good projects than we can do. So the idea that we're going to fund a company outside the Valley, much less in Europe, it's a really, really, really difficult one. Now, that doesn't mean it's impossible, but the bar is really high. It usually means you better be much farther along than any of my great companies, meaning you have proven that maybe you have great traction, great revenue, and so on and so forth. Or you're doing something so unique and special that no company in Silicon Valley is as interesting to me. So just keep that in mind. I see a lot of entrepreneurs from outside the Valley come. Yesterday, another investor was calling this tourist fundraising. Come here for a week, try to do a few meetings, hoping that it rarely works. So the two thoughts on that are, one, other parts of the world, and including other parts of the US, work much better. For non-Silicon Valley companies, I see them have more success in New York, in Boston, in LA, in London. Why? Because all those investors there are used to investing outside their cities, because the density of good projects is not as high. So consider that it might not need to be Silicon Valley. The other thing is, if you come and you move here, that's another story. Once you're here, then we don't care where you're from. Most people in Silicon Valley are from somewhere else. So whether you come from Spain or you come from San Jose, once you're here, you're here. So if you move here, then you're a local. But if you're based somewhere else and you're just trying to get the investors from here to help you, very long shot. So just thought I mentioned that. Okay, I'm gonna jump into a few non-fundraising points real quick, but before I do that, any fundraising related questions or anything about fundraising that I have not covered that anybody wants to ask or wants me to touch on?
Go on.
Okay. Go on. Feel free to, if you think of something, interrupt me. So just a few quick things in general. Again, I've been fortunate to have worked with about 100 or so startups, and about half of them have gone on to do really well. Half of them haven't. They've ranged in sizes. Most of them have been really tiny when they started, and some have gone on to have a few hundred, or in some cases a few thousand people. So I've sort of like seen the whole process over the last 20 years many times. There are a few things that I've found have been particularly useful for entrepreneurs. First one is you can't follow all the advice you get. I probably should have started this talk with that. And that doesn't mean when different people are going to give you different advice, and it's often in conflict. Now, it doesn't mean that one of them is wrong. It often means that there's more subtlety to it, that it depends on the situation, on the person, and that sometimes going left is the right thing, sometimes it's going right is the right thing. And you need to be sure that when you're hearing advice from people like myself, that you're understanding where we're coming from with different pieces and pieces. I've seen some entrepreneurs follow advice blindly. Oh, but you say I should do X. And I've said, no, hold on a second. That was in a different context. Things have changed. So it's important to understand where the advice is coming from, and then to take the bits and pieces that work for you. And the best entrepreneurs take from everywhere they hear and make their own model. Rafa, did you want something? Do you want? No? We're good?
Sorry.
Okay. Then the second thing I would say is, do not believe anything you read or see particularly about Silicon Valley, the blogs, the movies, the books. So I've been fortunate to have been involved with a number of projects where there have been books and movies, and I was involved with Twitter and with Zappos and with Yahoo. And you read the books, and it's like, this is not what happened. And what happens is, after you're really successful, nobody wants to say, we didn't have a clue and we got really lucky. And wow, we kept screwing up and still made it. But on the other hand, what people tend to do is, what we call revisionist history. It's like, oh, we knew that brand was going to be so good and we had this vision. And the reason why you have to be careful not to believe a lot of these things is because then I see entrepreneurs try to follow the model and say, oh, I want to do things the way Twitter did it in the early days. But that's not the way they did it. That's the way they think they did it, or they're pretending they did it. So you're following a false reality. And in general, the best thing you can do is just try to do a little progress, get to first base, build a tiny little company from there, make it a little bigger. And most successful companies, if I would have to summarize it with very few exceptions, they just go from a little bit of success to a little more success, and so on and so forth. And it's less about having that I'm going to conquer the world vision on day one. The other day I saw somebody say, oh, Yahoo could have bought Facebook for $1 billion, and they didn't. And this person was criticizing Yahoo and say, what a lack of vision. But look at it from the other side. Mark Zuckerberg was willing to sell Facebook for about $1 billion. And it's now worth $300 billion. Obviously, when he was willing to sell for $1 billion, he didn't think he was gonna get to where he got. He didn't know. Or the Google guys almost sold Google for $1 million in the early days. So anyway, don't believe what you read. Let's see. Quick point about speed. Obviously, you want to be nimble and efficient, and that's part of the advantage here in Silicon Valley. But most important is that you're moving in the right direction. And I see many entrepreneurs who are still figuring things out, but are moving really fast. And often they're moving fast in the wrong direction. And not only that, being in the right direction is much more important than moving really fast. So focus not so much on moving fast, but on quickly figuring out what's the right thing to do. And then focus more on doing it well than on doing it fast. In my experience, 9 out of 10 successful companies were not the fastest to execute. We're the ones who executed better. Now, the problem is those that are like uber explosive, super fast, they get a lot of press, but they're 1 in a million. They're just so rare. That's not the way most companies succeed. And if you look at most success examples, whether it was Facebook or you name it. It's just not about, wow, they were running like crazy. It was more about they were doing the right things. And then well, two last points, and again, I wanted to make sure there's time for any questions. People ask me how I choose the entrepreneurs that I work with, and I'm a little different in that I don't have a fund. So I'm not in. If you're talking with an investor who has a fund, at the end of the day, he or she is trying to maximize the returns on the fund, and that should be the main criteria. I mean, that's the limited partner to give him money. That's what they pay him for. In the case of angel investors like myself, we're investing our own money. It's more personal. Most of us are not trying to maximize the financial return. So keep that in mind. And if for example, in my case, I want to work with people that I'm going to have a good time with. The biggest, if I had to boil down my decision process to one thing, it would be the following. I meet with an entrepreneur or team, and at the end of the meeting, I ask myself, was that really fun? Did I have a blast, and do I want to make that a 3-hour meeting instead of a 1-hour meeting? If the answer is no, it's done. I don't even get to the point of thinking, is it a good space? Is it a good financial return? If I'm not having a blast, it's not worth it. So that's, and by the way, a blast has many dimensions. It's not just good entrepreneurs that it's a good professional, intellectually stimulating discussion. It's also about, are these good people that you want to go have a drink afterwards? The second related point is, can I help? There's some companies, they look great, but when I ask them, what do you need help with? If they say, well, we really, our priority for the foreseeable future is getting more European retailers. It's like, well, I don't know any European retailers. Why am I going to get involved with you? I can't help you with that. If on the other hand, they're growing and the challenges have to do with the details and the nuances of growing a startup, with a network in Silicon Valley and other such things, it's like, okay, I can help you with that. Then, and then the final thing I look at is this an impactful business? I've made investment in plenty of companies that were gaming or entertainment or advertising optimization, and that's fine. And this happens to a number of investors. After a while, we start to want to have more impact on the world. And that doesn't mean we only do social impact, although I do social impact investing. But when I see a company, I want to say, okay, is this really something that's going to make the industry better, that is exciting, as opposed to it's an arbitrage opportunity, a good way of making money, but okay, it's not particularly impactful. So those are the things that I look at. The final point has to do with helping, and what I would say is, in general, people in Silicon Valley are eager to help. And we're very open to helping, and not in a transactional manner. We're open to helping informally. Obviously, we cannot answer every email we get. It's just not realistic, or we would spend all the time doing that. But we do what we can. Now, what you can do to leverage the help from people like myself is to help us help you. And the example is that if, let's say, you want me to try to help you find an investor. If you say, hey, Ariel, can you recommend an investor? Let's say I understand that you're doing a business in video sharing. Well, that you're not helping me a whole lot, because then I got to go, okay, who do I know, and who is it, and is he good, and is he bad, and have they already spoken with him? But if on the other hand, you say, hey, Ariel, I did some research, and I found that this particular guy invested in a similar company, or has been tweeting that there's a need for a product like ours, or blogged about this subject, and so he seems like he would be a good fit. And so I wrote a little email that talks about that and gives context about what we're doing and what we think it'd be great to talk to him. And I also noticed that you work with him in this company or that company, or that you know him. Here's an email, can you forward that? So it takes me 30 seconds to send a note to this guy and say, hey, this looks good. Can I connect the two of you? And it's efficient, it works, and you're helping me help you. So I stress this because even after I did a talk to another incubator a couple of weeks ago, and I made this exact same point. And I swear to you, 2 days later, I got an email from one of the guys saying, "Can you think of an investor for me?" It just seems to be the default. So anyway, with that, why don't I open up for any other questions? And feel free to ask about anything.
Questions? Oh, I'll do it. Yeah. No. Okay. This is a question coming from me. Is about persistence. I mean, about being persistent with an investor. I've heard many stories. Some of them have been extremely successful. Like, for example, the guy that he was taught in BlaBlaCar, he was addressing all the time the guy that is Caviedes. You probably know him. Luis and Jose Caviedes, they invested in BlaBlaCar, and he was one of the home runs. Yeah. But this guy was asking all the time, okay, do you want to invest in us? And in the beginning, he was a student into the entrepreneur MBA he has in Madrid. So Luis was saying no. And then suddenly he asked again, and sorry, again, no. And it was, I think it was the fourth time. And he said, okay, now I'm going to be doing it. But it was a little bit more based on persistence than in tractions or thin. And at the end, it was extremely positive for both. I mean, we have, on the other hand, we have people like Naval Ravikant, who, you know, he was addressed by the Pinterest founder, and he was saying no all the time, in the first and the second and the third, and even he was feeling bad because he was sleeping with his girlfriend at that time, and his girlfriend was checking into Pinterest every single night, and he couldn't see the point. It's like, come on. So it was the girlfriend who was saying, I think you should invest into this company. He didn't do it at the end, but he was feeling the pressure from everybody. So what is a good ratio between being persistent and not being persistent?
Yeah. Well, so the first thing I would say is, again, be careful about hearing the BlaBlaCar story or the Pinterest story, because I don't know them well, but if I had to bet, I would bet it's not the way you describe it. I bet there was something else, it happened somewhat differently, and we just don't know about it. So you start following, and even if it happened the way you describe it, it's those really edge cases. Do you really want to go try to build a company based on these really, really rare cases? So, and I don't think you should. I mean, this is not that different than when you have an idea, a company, and it's not succeeding. And where do you draw the line between you're being perseverant and you're sticking with it, and you're being stupid and you're hitting your head in the wall for something that doesn't work? It's not always easy. I don't have an answer for you as to how to draw the line. What I would say is a couple of things. One, with the investor, is if all you're doing is just pursuing him or other investors and you're not moving the business forward, I think that's a huge mistake. Most investors will never say yes. Again, the ones that say yes, and then it's a BlaBlaCar, big story. But for every one of those, 100 never say yes. It's not a big story, and your odds are more 1 in 100, if not 1 in 1,000 or worse. On the other hand, if you are moving the business forward and you're making progress, and you're keeping the investor and you're being perseverant and say, hey, you sure you want to do this? Look, I got this other guy to support me. Look, I made this progress. I'd be very surprised if from the first conversation of BlaBlaCar and the time the investors agreed, there was zero progress. I just don't believe that. The flip side, I mean, look at in the case of Pinterest. If all of a sudden the investor is going, oh, look, I saw it here, I saw it there, that might lead them. In the case of Naval, it didn't, but that obviously might lead them to. So again, it also depends on the investors. Some investors, like in my case, that doesn't work with me, I can tell you. I mean, when entrepreneurs try, I do one or two things. I say, look, I'm not interested, it's over. And if they email me again, I'll delete the messages. I won't even respond. Why? I have too many people that I honestly find it somewhat disrespectful. If somebody says I'm done, then maybe you do a little bit more I think particularly investors, we're really busy. So if somebody takes the time to respond, I always do that. And then the entrepreneur just ignores you. Listen. Now, other investors might like it, might go, wow, this guy has grit, what have you. But you have to try to measure it. For startups, back about when you give up and when you keep going, which might also apply to investors, you look at it and you say, am I still excited about this? And are there other things I can be trying? I was on the board of a company that was not getting traction. But the investor, the entrepreneur would ask the board, hey, every time he would come and would say, this is not working, but here are the next 5 things I want to try. And my feedback to him always was, as long as you're excited and you have 5 more things you want to try, great, do it. Well, he kept trying, and then he got to a point where he said, you know what? I just cannot think of anything else I want to try. So at that point, he said, I'm done. Now, we were able, again, we're in Silicon Valley. He had a good team. He had some good assets. We sold the company to Facebook. It was okay. But that's when he said, I'm done. So maybe with an investor, as long as you're thinking of new things to say, new approaches, you keep trying. If at some point you go like, okay, this is it, then maybe you stop.
Okay.
Anyway, long answer.
No, it was perfect. Questions?
Ariel, if you may an advice for an entrepreneur that is having his first investment, starting from the scratch, which will be?
Sorry, I did not understand the question.
Okay, if you please could give an advice for an investor who is getting his first investment, starting from the scratch, which is the advice you think is the most important, or the one you can share with us?
For an investor?
So.
Yeah.
When
the investor is the first time.
Like for the so the first thing I would say is that I don't like generic advice. There's so many situations, so many different people. So this fictitious investor, I don't know anything about him or her. I don't know where they are. I don't know what the background is. So I'm almost hesitant to say, oh, do this, do that. I don't know. I mean, you really need to look at it case by case. But since I don't want to avoid the question, what I would say, what worked for me and something I see work very well for investor in terms of making the first investment is look for projects that you can add value and not worry less about making an investment and more about adding value. So what you see a lot here in Silicon Valley, many investors start by being just informal advisors or formal advisors and adding value, and they look for projects where they bring something to the table, and then at some point you take it from there, as opposed to, okay, look for go to Y Combinator and pick one, or look for the one where you have the lowest valuation, where you can make the most money. But again, it really depends on the people. Somebody who's outside the Valley might be well served by going to YC Demo Day. Someone else might be well served by going to AngelList. It's really, really specific. I think it's dangerous to give sort of like those big answers.
Okay.
Another one. Yeah.
We have identified several ways of monetize our project, but how many of them should we present? If we present a lot, is good? Is it bad?
Sorry, how many of what you present?
We have identified unless say 5 to 7 ways to monetize.
Okay.
Yeah.
Well, I get it. So, well, the first thing I should say is you should be honest. Meaning, if you haven't figured out how you monetize, you just have a bunch of possibilities, then that's what you want to say. You should say, we still don't know how we're gonna monetize. Here are some possibilities. You don't want to pick one if you for real haven't. So there should not be a gap between your reality and your presentation. So that's the first thing I should say. Now, if you present as many as 3 different monetizations, or even 2, I think most investors would read that as you still don't know. I think what works, and the other thing is either you don't know, or you don't know that you need to focus and as a startup, do one thing at a time. So ideally, but again, you can only do this if you're there, is you say, we're going to start with this monetization. This is going to be the main one. It's exciting. You can build a big business. But by the way, there are other possible ways of monetizing, and either we're going to do them later or they're going to complement it. But they shouldn't be all one next to the other. You should have, here's the main one. And if it's just that, we have a great business. But here are another couple that could also help. I think 5 is way too many. So if you maybe say, here's the main one, here's 1 or 2 others, and then you might even verbally say, by the way, 10 years out, there's other possibilities. But I would, yeah, so that's what I would do.
Okay, I haven't introduced, the first one was Alberto from Italy. You have Jonathan and Mary. They are from Venezuela, so good compatriots. Very good. And now is another coming from Aiste from Lithuania. So,
Hello.
okay, you probably see him.
Okay, I wanted to ask a quick question. How to evaluate startup? How to evaluate a startup rightfully, not to overcome and not to overdo?
Sorry, how to evaluate startups?
Yes, like the right price.
I'm not understanding.
To put a value. The valuation of a startup, she's asking about.
Oh, the valuation.
Yeah.
Yeah. So the valuations are, well, I can tell you what it's not. It's not about looking at financials and looking at what the revenue is going to be and the EBITDA and the multiple. I see, particularly sometimes from outside Silicon Valley, presentations that have that, and then they say maybe, well, and we can sell it for this much, and so we're going to give you an IRR of 15%, so that's why it should be worth X. We don't think about it that way at all. It's a lot more about, at the end of the day, supply and demand, meaning you want money, some people hopefully want to give you money. And the more people want to give you money, if you're trying to raise $500,000, but there's probably 10 times, $5 million of money out there, you're probably going to be able to have a high valuation. If you're trying to raise half a million, but you can get 200 on the table, it's probably going to be low. So it has a lot more to do with this supply and demand. And obviously in Silicon Valley, everything tends to be higher because there is more activity, so there's more supply of funds than in other places. And there's also a sort of like rule of thumb. So in general, there's a range for, say, a seed company that typically the valuations we see here are somewhere between, say, $3 and $8 million. And this can be done as a convertible note with a cap or as an equity. It doesn't really matter. Now, why 3, why 8? It has nothing to do with the numbers or the stage of the company. It's more about how hot is it, how interested they are, how good of a negotiator the entrepreneur is. It also, there's another factor, which is if a investor is going to take a lead position. So for example, let's say you're trying to raise $1 million and there's somebody saying, okay, I'm going to do $500,000 or 700,000. Then often they do the terms. You go to them. It used to be that it was always that way. The entrepreneur would go to the investor and say, you tell me. So the investor say, okay, here's a term sheet and I offer you that I'll do 700,000 at a $7 million valuation, whatever it is. And then you go with that and you raise the rest of the money. On the other hand, if you're just doing more of a party round, meaning it's $1 million, but it's going to be a bunch of $50,000 and $100,000, and a lot of these might not be sophisticated investors, so you have to go to them and you say, okay, here are the terms. And usually what entrepreneurs do is they pick something that's reasonable, and reasonable, again, depends on the range. I know better about what it is here in the Valley. In Europe, it's probably a little less, but there's no science to it. It really is, as I was saying, okay, how many, what can I get away with, and so on. The other important aspect is how much you're raising. So if you're raising, let's say, it's a small round and you're raising $250,000, and you try to do it at a $5 million valuation. Well, what that means is that you're only going to give away 5% of the company. And that's actually kind of low. And I would say it's unfair. You're really going to give only 5% of the company to the early investors that are going to make things happen. On the flip side, You know, if you need to raise $2 million and you do it at a $5 million valuation, that's a lot of dilution. That's whatever, 25% or so. That starts to get a little high. So depending on how much money you're raising, then the valuation could be higher or lower. And in general, for a seed stage, I think the rule of thumb is it should be probably no less than, say, 10%, and ideally no more than 20%, roughly. Maybe 25 starts to get on the high end. But of course, I've seen people, maybe it's a serial entrepreneur, maybe they have something really hot and they only give away 5% of the company. On the flip side, I've seen entrepreneurs who are really struggling and they want to get the money and they might give away a third of the company. It shouldn't be as important as it is for most people. For you as an entrepreneur, startup is a marathon, and yeah, you don't want to give away half your company right away. But if you end up giving 10 or 20%, it's not gonna be that big of a difference at the end of the world. And for me as an investor, it's the same thing. If the company is valued at 7 million or at 11 million, you know, either it's gonna be worth a lot or it's gonna, I mean, the reality is most investments say they're worth a lot or they're worth nothing. So I don't care as long as it's fair and reasonable. So anyway, that's the answer.
Thank you.
More questions? Yeah, you got move over here. That's it.
It's Pavel from Russia.
Hi. Is it important to have a really detailed breakdown of costs, or it's something which we can play on? So, cost breakdown, yeah.
Cost breakdown.
For investor, yeah.
Well, so here's what I'm not sure I understand exactly what you're saying. Let me try to answer. You tell me if I don't. You need to, depends on the business. Some businesses are very obvious and they've been done before, and I'm doing another social network, or I'm doing another this or that, software as a service, whatever. So, you know, we know the way it works. You need to show me an analysis of how this software as a service company is going to work. If I've seen 10 of them, maybe not. Although you need to show me, you know, that you as an entrepreneur know what your plans are. In general, showing me that you understand your unit economics and your margins is important. If you just tell me, oh, here is how much revenue I'm going to make, but you don't show how much it's going to cost you to acquire a customer or service a customer, and it's not obvious that it's very cheap, then you might not have a good business in your hands. So you do want to show roughly you understand your unit economics. Not necessarily that you have a 5-year plan with projections and all the details, but that at least you say, look, I can make $100 per customer. It's going to cost me 25 to acquire them, 25 to service them. That's my 50% gross margin, something like that. Now, in terms of use of proceeds, I don't know if that's your question. If I'm trying to raise $1 million, then you do want to show roughly where that money is going. So you say, well, with that money, we're going to support a team of 7 people, and we're going to be able to do this particular marketing or that particular test, and that's going to support us for 18 months, and that's roughly where the money goes, and hopefully what we hope to achieve during those 18 months. So I don't know if that answered your question.
Yeah, just a little additional question. For example, there are often situations when lifetime value of user is really great, but to prove this lifetime value, you need some history, yeah? While startups often lack it, so lifetime value is often kind of projection, yeah? While the acquiring costs are also high. So are there any tricks how to convince an investor that this lifetime value is not a bullshit, etc.? So are there any strategies like to work with?
Well, I mean, so I have 2 comments. One is obviously the lifetime value is important, but if you're not going to recoup your cost relatively quickly, the lifetime value, it's irrelevant. So to give you an example, if you tell me, oh, look, each customer lifetime value is going to be $2,000. So if I spend $1,000 on each, that's still, I'm making $1,000 per customer. But if that's going to take you 3 years to recover, so that means it's going to take you 1.5 years just to break even. That doesn't work. I don't care. It's just the cash flow is going to kill you. On the other hand, if you say, well, the lifetime value is 2,000, and it's going to cost me 1,500 to acquire them, but guess what? I recovered the lifetime value in 6 months or in 4 months, so that I'm breaking even in 2 or 3 months. That all of a sudden is a lot more compelling. So even, or I should have given an example with less lifetime value. So the time to recover is super critical, and that goes to your question, because if the time is shorter, then you start doing tests and you can show it. There's not as much uncertainty about, is this customer really going to stay for 2 years? If you can, ideally, you want things that really quickly you can recover your acquisition costs. Now, if on the other hand, your acquisition costs are small and it's maybe very organic, then who cares about, I mean, if the lifetime value is X or Y, it's not going to matter as much because it's still going to be very profitable. So I think, I mean, that's what I would say, that and then the second point I would say is, if there are comparables that you can use that might make the investor feel like, you say, look, this is similar to that other business, and here's why, and look what they're doing, and here's why we think we can achieve the same. Yeah, you might, again, hopefully you're doing things out in the market and validating it. But yeah, that's uncertainty. And by the way, it's not just the investors. I mean, many times for the company itself, you just don't know. And then you don't know how much you can spend acquiring a customer because you're not sure what the lifetime value is going to be. So it's a pretty tricky thing.
Yeah, thank you.
Okay. Last question. Like, talk about the early startups, like when making a forecast, okay, so financial forecast, both on revenue and cost, what do you think would be like a reasonable horizon? So, because I heard the investors, they would like to see, well, just show me like the first year. Other investors, they would like to see the 3 years, other the 5 years. So what is your what's your thought on it?
Again, it depends on the situation and depends the purpose of the forecast. There is the shorter term forecast, let's say, call it a year. That is to show, A, that you know what you're going to be doing in the near term. It's more of an execution plan as well. So it needs to be tied to the execution. And if you don't, and then B, that you understand the funds that you need to execute in the short term. And that, obviously, it's important to have it and to have as much detail as possible. Now, there's the purpose of, say, a 5-year plan or longer is to show that this is a big, exciting business. It's not to show that you know exactly what the numbers are going to be, or that you know exactly how you're going to be executing 5 years out, or how much funds you're going to need 5 years out, but to show that, look, in the next year, the year one, we think we can generate whatever, $3 million. And if you just do that, and you're pitching me an investment, and you don't show me that this can be a $100 million company, I might just say, well, that's looks like a small. No, you're showing me $3 million. I'm not interested. I mean, a sophisticated investor. If on the other hand, you say, well, we think we can do 3, 8, 20, 45, 100, whatever the number is. And we know you don't know what's going to be, but you have some reasonable assumptions. Here's roughly how we can grow. Here's roughly how we can get there. And by the way, once we get to the 100 million in 5 years or 7 years, that's a realistic number, because at that point we've only captured 3% of the market. It's not like we need 70% of the market to make those kind of numbers. Which means that we could keep growing and reach 10 or 20% of the market. That's going to be even bigger. So the longer term numbers are meant to show that there's an interesting opportunity, and that this is worthwhile investing in. It's less about the details and more about the model and the assumptions. The short term stuff is important so that you know how to execute. That's what I think it's worthwhile. An investor who wants a financial P&L detail for 5 years wouldn't be as sophisticated. I mean, no sophisticated early stage investor is going to ask you for that.
Thanks.
Any other questions? Okay, I have a quick one about some metrics for you as an investor. I think we have 5 minutes or less.
Yeah, no, 5 minutes. I got to run, but yeah.
what would be the minimum multiplier that you will have in your head for an investment? So 20x, 30x, something like that?
I honestly don't think about it that way. And I'm not sure. I mean, I think different investors are different. Less than multiplier, I want to say this could be a really big company. And I'm not going in there. And now what that translates to really, really roughly is that it's very difficult. If I'm going in at a seed stage at a $10 million valuation or less, or even say 20 or less, and this could be a really big company, and a really big company means that it could be in the hundreds of millions, then that means that this company is gonna, if things go well, it's gonna be at least a 10x. But it's not that I'm looking for the 10x, it's that I'm looking for, I want this to be really big. And but I'm not doing the back of the envelope and saying, oh, wait a minute. If the evaluation is 15 instead of 10, then instead of a 10x, I might get an 8x. That's not good for me. These things are very hard to predict. Now, in my case, if I look at it and I go, well, this I'm going in at $10 million valuation, and this might be a $50 million exit, so it's like a 5x. I mean, 5x is fine, but I'm just not that interested in getting involved with companies that are not, at least have the potential of being huge. By the way, just to be clear, many of my exits end up being 3x, 5x, 8x. I'm thrilled. Don't get me wrong. I mean, I'm happy. I mean, that's a great return. And it's not that I'm like, oh, that's terrible. I only got 6x. Now, when I went in there, I thought this could be humongous. And of course, you know, I've had some 50x. I mean, what you really want is the 50x, the 100x. And that's what we get. You know, when I invest in, you know, exits that you know, companies that you invested in the sub $10 million valuation, and then they're worth billions, then the kind of multiples you get can be 50x, 100x, or even more. And all it takes is one of those to really take care of everything that you're doing. But I think it would also be silly to just go in there and say, unless I see 100x, I'm not investing. Because you don't know up front. You just don't know. I mean, just to put it, you think the early guys saw Uber and immediately saw, I tell you, I was there. No. Oh, this is a good one. Okay. But it's not like, oh, this is going to be the 1000x. No. It's impossible to know.
What about the timeline? How many years?
Again, different people are different. For me, look, one of my best companies I'm on the board of, called Freedom Financial. I've been on that board now for 12 years. I love those guys. Now, it went from just 2 founders and I'm helping them to now they have 1,000 employees. We're 200 million plus in revenue, super successful. Do I care that it's taken all this time? No. I mean, I don't care. I mean, again, I don't have a fund, so it's not something that for VCs is a little bit different. If the horizon is not 5 or 7 years, then things start to get a little. But the one thing about timeline is the following: if it needs to grow fast enough so that it can maintain my attention. If I see a project that goes 1, 2, 3.5, 5.5, 7.5, 11, so it's like, okay, after 5 years, you're gonna be doing $11 million. Oh yeah, but look, in 15 years, if I look at it from the start, yeah, that's hard to get excited about. But it's not because it's gonna take too long for the outcome. It's because of the growth rate. It just feels like, oh my God, this is just, and that the other thing is what we're good about here is about fast growing companies. That's also where people like me add value, not for things that are more incremental.
Okay, so thank you very much. Thank you very much.
Yeah, I got to run, but good luck to all of you. And yeah, if any of you have a specific question about your business or something like that that you think I might be able to help, you know, Rafa has my email, so feel free to zap me an email, and if I have an answer, I'll try to give it to you.
Yeah. Okay. Yeah, thank you very much. And, good luck to your wherever you go,
good luck. Okay, it doesn't matter.